And a report where I share my 45 years of experience to help you manage your portfolios and protect your wealth. Remember to subscribe, like, and share these videos. In tonight's video, I'm going to set up what expectations are for CPI and looking a little bit toward the Fed meeting. So let's get into tonight's video. Well, welcome, folks. We've got a fair amount to talk about. We've seen some pretty decent volatility today, to say the least. And I'm going to try to set up this expectation for CPI. Those of you that are reading my Substack on a regular basis, I wish more of you were on there. You really should go to kindlereport.com .substack, or actually kindlereport.substack.com, and that'll get you there set up. I'm actually going to lower the price back to $8 if you sign up for a year. So I'm going to put that on there probably after this video today. And if you have paid up for this, just send me an email and I'll refund you anything that we had. I just feel like this is a much better pricing mechanism. I want to make it available to everybody. I seem to price some people out, and I don't want that to happen. So let's get into talking about what we're expecting here as we come into the CPI tomorrow. So expectations right now are CPI is supposed to be 2.6 year over year, up 0.2 is what the expectations month over month. And then we have last month was 2.9, so they're looking at a further downtick. I have to go into a little bit of this dialogue. Maybe you folks are getting tired of hearing about this, but I'm still questioning everything we see. I've always questioned this. I've discussed this before. Back in, I think it was 1980, I had to do a speech in front of a crowd and talking about government reports and which ones you could trust and which ones weren't being adjusted, seasonally adjusted. Now what we see is something different. It's beyond seasonal adjustments. It's political adjustments, I think, to make things look better. So we know that the employment number's been overstated. I know I've said this. Some of you don't get the Substack. You haven't heard this, but we got all these overstatement, 818,000 jobs that didn't actually exist. Every metric that's out there needs to be adjusted. But yet we got employment numbers last week. We got participation numbers that come out last Friday. None of these metrics changed at all. They didn't adjust them, but they somehow have fewer jobs, but none of these other numbers. So we're living in some kind of place where trusting the data always has been in question, but even more so now. It seems like somebody told me once that 2024 was the year that all of the corruption and everything was going to be exposed. And it sure would appear that just in in another hour or so, I think maybe it's already started. I'm not sure what time the debate starts tonight, but this is going to be epic to watch this, I think. So I'll try to get through it so we can get the market set up and all that. But this is a big thing for me, and I think for a lot of folks that are market participants, especially analysts like myself and people that are involved in managing a lot of money. I think that's something that we need to really pay attention to. But I going back a little bit as well, just talking about some of the dialogue I've had on Substack, is I've been talking about this echo bounce in the inflation numbers. Now, this was not to be until September when we get this bounce. So we don't get the September numbers until the next month's report in October. And then October is another one of those months where I expect some sort of bounce. So it's going to be interesting to see how the Fed handles themselves next week. So I'll kind of go into what my expectations of the Fed is. And it's going to be interesting to see what type of actions. There's all kinds of people throwing out 50 basis points. Why? Because the markets went down. There's so many people out there that still think the Fed is trying to micromanage the equity markets. I don't think they're doing that at all. I won't get too deep into this, but I do believe that the Fed is taking a much longer term view, and we are going to see rates start to come down. I think they're going to come down fairly drastically, 150 to 200 basis points in 2025. Maybe it starts next month. I think this is more window dressing than anything. I'll bring up the Treasury charts, and I'll go into more of that dialogue. But the scenario that I'm trying to paint here is the Fed may be seeing maybe what I'm expecting, which is some sort of bounce in the inflation numbers, CPI and PPI. We'll see how they come out tomorrow. I don't expect necessarily what a surprise is going to be, but there's always this element that I'm a month behind on what my expectations are. And I just want to put it out there. Somebody's like, what does surprise mean? It means that we may see something unexpected, okay? And whether it's an uptick, I don't think we get an uptick right now, but I do think that we need to be on alert for this. And the ultimate is going to be for that the markets are going to start to anticipate some of these moves, and they may get a little bit ahead of yourself. Look at how the market traded today. Let's just bring that into focus. It looked like we're getting a decent little sell-off early in the session and just screen back, short covering. I'm just looking at another screen here. We're trading back at 5,500. This is the number I discussed in the last two sessions on the Substack, that we're going to rally back to around 5,500. We may see 55.12, 55.40. I'll go through some numbers here in just a couple minutes. But these are, what we're seeing here is this really sharp bounce back. I hope you guys caught it. I did. When we traded down to 53.96 last Friday in the aftermarket, I put in some positions there and held them over the weekend. Not a huge position, but enough to be interesting. And that was the perfect place. I talked about this 53.92 on the S&P for probably weeks. It's a pivot number. I'll show it to you here in a few minutes when we get into the charts. But that number was absolutely stellar. And also the other dialogue that I keep talking about, I don't have the results of the database for today. They won't be done until about an hour after we finish this live stream. But I will talk about it in the Substack. And by the way, the Substack, there's a 7-day free. So wait about an hour after I get done tonight, and I'll adjust all these prices. I just didn't have time to get done with it. But this is, I think it's a must to have if you want my micro analysis. I've put a lot of work in this. And matter of fact, I'll show you a couple of things from that I think you'll find interesting. But the bottom line is what we're seeing potentially coming from the Fed. When we get into the meeting next week and we hear Powell's remarks, my expectation, if they only do 25, I think they will, because I think it's more of addressing what's already happened. We look at the back end of the curve. We're trading into the 360s again on the 10-year. So they're going to need to start bringing in that front end of the curve. And I'll save some of my curve talk as we go through the video. I want to delve right into that, but I'm going to pass for the moment. But the expectations for CPI may be a surprise from the standpoint, maybe we get an uptick. It's funny, you see things, and they keep saying, well, inflation is moderating. And then a good example, like real-time example, my wife goes to buy some olive oil that she always buys. She buys it online, and it literally is up 30% from 2 months ago when she bought it. So somehow everybody's, whether it's, we'll do air quotes, price gouging or what's going on, a lot of folks are still raising prices. There's still price pressure out there. And it's interesting, when we get in a few more minutes here, when we get in the S&P, maybe we get in, matter of fact, I'll save it when we get into the interest rates. I'll discuss exactly, I'll show you some charts and what our forecasting tool or our ogles are telling us about the potential for the CPI and all that stuff. I think there's some interesting potential here for that echo bounce. I don't think it's like a new insurgence in some new inflationary cycle, but I do think there's still pressures out there that have not gone away. And I'm betting that the Fed sees the same thing that I'm talking about. And so the results will be interesting next week, and we'll have plenty to talk about, if at all possible. Just so you know, those of you who joined, my plan is to do live streams for the next 2 sessions. So same time around 7 o'clock. That's a good time for me. I think I can pull it off the next 2 days. There is a couple things that could come into play that I might not be able to respond to, but I think everything will be good as we come in the next couple of days. Anyway, I'd like to see what we get out of PPI or CPI, and then talk about the PPI tomorrow and see what we can look into the future a little bit from that standpoint. So yeah, I'm just looking at a couple comments. I'll let that go. So let's do this. My plan is that's the setup for what I think is going on. So let's get into and take a look at some of these CPI numbers. Let me get this up on the screen. Hopefully we have a glitchless live stream. Still adjusting to my Mac. It's been an interesting challenge. I'm going to start off, you know what? I'm going to, bear with me 1 second here. I thought I had this all set. I'm just about there. Just see what. Let me look at a couple comments and I'll cover this while I'm trying to find this. So you're seeing a change at the grocery store, Henry? Just because I'm not seeing it. And I'm kind of an instant cart, so we got copies of all of our other bills. I'm not seeing it drop. Yeah, I wouldn't, Lotus Trading, I would agree with you. 0.5 would suggest that there's possibly something bigger is going on here. Let's see if I got it. Perfect, I got this. So let me show you this. This will be interesting, I think. So this is the CPI year over year that I brought up here. And what we're seeing here is the forecast, which is interesting, still showing, this is what I've been seeing for a while and I've been talking about, is that and these ticks, I'll try to bring it where the next tick is going to be, but it's still showing a slight drop right now. But the forecast of the algos are suggesting, you can see the red dots here. Let me move this over just a little bit, so over to the right. You can see the red dots are suggesting, this dot here tells us that we're going back to 3.6 from 2.5. That's a full percentage. It's certainly not, where we were up here at 6 and 7%, but it's suggesting that this is, there's another drop here in August, and then as we get in September, October. So let me move this around. So the next meeting is suggesting a move to like 2.75, and then potential, and then like a little flat spot as we go through the election time. As we come into October, we're looking at 3%. That would be a crazy bump. I don't know that we get that, but my argument here is, if the Fed's seeing some potential pressures out there, they're going to probably do a 0.25. They could still do nothing, by the way. If you go back on some of the comments that I had for a while, is that I think that the original thought was they won't do anything. I think they got enough pressure, and them adjusting by 0.25% is going to do absolutely nothing to that. And I'll save some of this conversation as we get into the interest rates, but I just wanted you to see that number because I was covering that. So here's the plan. We'll cover the S&P, NASDAQ, and then we'll get into interest rates, and I'll talk a little bit about the yield curve. We'll get more into this because this is what the theme really needs to be looked at. Will we get this echo bounce that the algos are projecting? And I can tell you the accuracy on these things. I could run a script and you could see how the forecast has went in the past. It's crazy how accurate this is. And I guess while we're early on, I know a lot of you have the indicators. All you have to do to create this is go to any of the WTAR SMA projections and just set the period to 1, and that'll do it. So then you can set it up. I'm going to make a video on how to do this because I've been getting a bunch of emails from it. So it sounds like I have some new secret indicator. It's just part of the suite that you folks already have. So yeah. So let's see here. Yeah, so let's go ahead. Let's go to the futures here and take a look at what's setting up. This is weekly that I'm on right now. It's worth taking a look at because check out I'll just show you the algos right now. The red dot, what I call closing projection, which is just a WTAR set to 1 with a coefficient of 150. And I think there's a 14 bar look forward. So 14 weeks looking forward. For the most part, the 2 or 3 are the most accurate, but it's kind of nice to see the potential of the pattern because the way this indicator works is it's looking at past the coefficient and projecting what is likely to happen. Doesn't mean it will happen, but it does give us a pretty good, yeah, and I am saying that CPI, the projections are that it's going to go up in September, October, and this is why, and I'll show you in a minute, we go through the interest rates, but this is why I do not think that the Fed's going to do more than 0.25 and why I think there's probably just an adjustment coming from the standpoint of the front end of the curve. More on that in just a minute. But so the S&P, if we start to look at the algos, this is a weekly chart that I've got up here right now. PPM 1, 2 are both looking like they want it to accelerate. And so what we're likely to do, and I've been saying this for those of you who have Substack, this has been the dialogue, is that what we're really setting up here is a very broad sideways trading range. And we're not in, while we still have a slight bias to the upside, we're not in any kind of rollover scenario. This is not what the charts are going to look like when there's a big collapse coming and the market's going to roll over and everything happens. The only reason something like that would happen is the classic black swan. There's something that we don't know. I always think about this, the old Rumsfeld, the unknown unknowns. So those you can't do anything about. But for the forecast, they're pretty good. For those of you who've been around this channel, if you go back to the pandemic, our models, which I'll bring up here in a minute, our models were actually projecting in January and February of 2020, we were selling just about everything in sight. And my institutional clients, I didn't know any, and a lot of you folks in, but institutional clients are calling me like, hey, we're getting all these sell signals, what's up? And we were right at all-time new highs right before the pandemic, if you recall. And then they turned the switch off and everything collapsed. And so there hasn't been a scenario, and I've been doing what I do with the software, all this stuff since 1998. There has not been a scenario going back to those days that the database hasn't had some kind of signal that there was going to be attrition on the downside of the market. So right now we're still 70% long. Show you that in a minute. But this weekly configuration is suggesting that we're going to rally and just stay in the sideways, keep trading at these upward bounds around, I think 57.20. You can correct me if I'm wrong, but 57.20 was approximately where the old highs were. Actually, I can bring that up. It was 57.21. So the old man's mind's still working pretty good. But the forecast is that we're going to continue to kind of push up against those numbers, and that will be that's what the forecast on a weekly basis is. So let's get into the, the micro, and let's look at the daily models, see what they're uh, projecting. We actually have some Fibonacci projections that are telling us we could go to the 200, but I told you I'd show you this number. You'll see this green dots coming across. So those of you that have the indicators, you'll see these extended dots. This comes from using the Fibonacci projection tool. So that tool actually goes in and recognizes patterns on the charts, and all of these fib targets are being automatically generated. They're not, you don't have to figure out where the high low points are. I'm not going to do a overview of the indicators, but that's how you get it. If you don't have them, kendallreport.com/indicators. Check it out. You can find out more. But what this is projecting on a daily basis is that we're going to stall right around this 10-period moving average. And this is basically what I've been talking about on Substack. The short term looks like we just set up this consolidation range. So, I didn't show you this number. So this little dotted number right here, you'll find that right over here, 5392.23. And on this Friday, if we look at the data, I'll put it in the data window, you'll see it up in the upper right up here. That window, the low was actually 53.94. So we came 2 handles from that low. And you can see we closed week, we opened higher on Sunday night, and then off we go as we started this week. You can see the last 2 days, and now we're slightly positive right now, but we're probably working toward 2 points on the chart. The 40-day moving average, these are simple average, and then we've got the 10-day, which is coming down. And the pattern that most likely we're going to stay in, I'm going to draw in a couple things. Hopefully my drawing tool doesn't give me good. Everything's working fine. Awesome tonight. So let me just show you. Let's draw in a couple things here. So we got this big pattern up, and basically we got this rejection off of this high here. What my expectation is that we're going to get this downward sloping 10-period moving average is going to be somewhat of the cap of the markets from that standpoint. You could probably draw a little wedge up here off of this number, but the big number out here is this, we could see a consolidation that ultimately comes across like this, where the market literally stays in this range, and we do not take out this low here that we made in August. So the August lows hold, and then we get just more consolidation. Think about it. Who's going to make a big move in these markets right now prior to election? Maybe after tonight, there'll be a clearer path. But even then, you're not going to make any moves in the markets. There's a lot of uncertainty. We don't know what the Fed's going to do. We'll see what kind of rhetoric we get. I think regardless of what the Fed does, we'll continue to hear this inflation, data-dependent numbers. I'll talk about that in a minute. But this is most likely the setup. And this setup goes pretty much across the board from the standpoint of what's happening here on this. But you can see the algos are suggesting on the 21 that the 21-day moving average is going to start to accelerate to downside. So that's going to be your cap, 55.60. We're probably 55.40, 55.60. That should be where this thing pushes out, even if we get a volatility spike tomorrow, which is possible. And we'll get those volatility spikes around that. And once again, you should be using an intraday chart. I would use an hourly chart to help define that off of the market grid on that. If you're trading using my indicators, that would be the best place. But the algos are suggesting a bit of upside coming into Friday into next week. So we're going to have probably a little short covering, a little neutral as we come in. And then I'm just looking at the numbers here. Yeah, it looks like the bottoming is happening. Guess when? Wednesday, right? Right with the Fed, and I think that Powell's going to find a way to keep everything pretty neutral to dovish as we go. Let's go ahead and go to next market. We'll go to let's go to Nasdaq real quick. This pattern's a bit different, and I've been discussing this as well. We got a little deeper retracement here. Let me draw in a couple things, then we'll go to the algos and take a look at them. But the bottom line is this retracement here almost came back to this rising 200, okay? We do have fib targets down here on the NASDAQ are pretty ominous, which would be a swing objective. So let me pull this off. What that is representing is this. Those numbers are coming off of this pattern here and projecting down into these three levels. So if we get a typical swing, this is on a daily, this is where we end up, and those numbers, fib 16,200 would be the extreme on here. And you can see the numbers over on the red where the fib targets are. You can see each one. Fib 1, 17,689, 17,765, and then the 16,200. So that is your ratios. That is that swing is equal to the first swing, and then there's a 1.382 and a 1.618 calculation in the length of that. So that's giving you your swing objective if that's what's going to happen. So let's peel all of this off and let's take a look at exactly what expectations are from the algos. They're suggesting that the opposite is going to happen, that we're going to hold this 200, that the pattern, so you can see here that we have upslope, we have improving momentum, we have a little bit of acceleration on the downside, some more pressure here on the 21, but all that tells us is that the cap of the market is going to be like 19,300, 400 range. So if we get up there, you'd look for a rejection. There's going to be some great trades, I think, in the next several weeks just trading this range. I don't think there's enough of anything out there that I can see at the moment that's going to do this. I think somebody commented earlier, like if you did 0.5 on, if the Fed dropped 0.5, that would be viewed as there must be some extreme weakness and they're panicking. That would probably be more of a negative than a positive. And I'm going to go into interest rates next. I will bring up the Russell for just a minute. I'm going to show you a couple things on the Russell as well. Okay. So let's make sure. Yeah, let's go ahead. So once again, this whole setup, like I said, let me draw this in. I want to make sure everybody sees this. So I've been doing this for a long time. Matter of fact, you may have caught it that I said this is my 45th year. September 1979 is when I started in the markets. I realized when I was coming live tonight that I have an anniversary. It was actually right at the beginning of September of 79 when I started in the markets, Chicago Board of Trade, a long time ago. But anyway, let's take a look real quick at these numbers. I'm glad to be here to share these thoughts with you folks. Okay, let's go ahead and so here's what this setup is. This is almost perfect. This rising 200, and I'm going to show you some metrics here. You can see the algos are suggesting that we get kind of a upward rise here, coming back above these averages. We're a long ways from this top over here, setting this up. I'm going to draw in what my expectations are. Is really what I see is this, is just setting up some kind of zigzag pattern. We hover along here, then ultimately when we get above here, we'll probably have to go to, this is the daily, the weekly charts will have a better setup. So let me just do that so I tie everything together. How am I doing? 30 minutes in. That's fine. Let's go ahead and let's can this. I want to bring up the weekly because this brings a bigger picture. Those of you that are maybe new to the channel or something, one of the things that I use as basically different series of charts or different lengths of charts to pick up these patterns. So I'm sticking here without any algos right now, just looking at this. You can see the forecast tool is suggesting that we get up to 19,300. That's the same numbers around that 300 to 400 level. That's where we should cap out. That's where right now these dotted lines are where the moving average are using our proprietary price pressure momentum tool to project out where this is what the moving averages are projected to look like. And depending on what type of prices we get in here, they may adjust a little bit, but this is pretty accurate. So as we look out, this is where the market's going to go. And just to draw in that pattern one more time on a longer term basis, this is what my expectation is from the standpoint of hang on, I'm just trying to get all right, so this is the big pattern here. This is probably going to end up to be walking along this line here, and maybe we get an ABC or an ABCDE. We get some kind of wedge pattern. I talked about the patterns that are out there, especially if we went to the next level, which I will save as we come into October. I do a longer term viewpoint, but the monthly charts all have a really great angle of attack on the moving averages, suggesting that sideways consolidation, this is what it should look like if we go to the next time series and we go to monthly, and we can even go next level and go to a quarterly chart. All of those charts suggest there's still an uptrend. We're not at that inflection point, in my opinion, where we're going to see this big collapse of prices and everything's going down forever, and the AI is over and the whole world's over. I don't see that at the moment, but this is most likely the pattern I've got set up, how the equity market's going to look. So let's pull this off. We'll do a quick review of the Russell, and I'm going to show you something else on the Russell that I've revealed to you in the past. But let's use RTY. This thing is just a mess. You couldn't find hardly anyone. This is the weekly chart. Everybody got all in right at the top. Here's telling, matter of fact, I on my Twitter, people are telling me, oh, it's going all-time new high, all this, this is the way to go. I'm an old school guy, been around a long time. I believe in the rotation to the small caps. But right now, until we see the yield curve get more in a typical, I'm going to go through interest rates next, so this will tie together, because everything when you're talking about interest rates, you have to relate this to what's going on in the Russell, because nothing changes in these stocks here. You got lots of banks, small to mid-sized banks in here. Everybody most of the companies in here all have some sort of interest rate exposure, and primarily with that front end of the curve being kept so high that there's no place for them to finance, to do things that are going to cause this growth and cash flow and the things that you need to have stocks going up. So this is basically, we've fallen back into pattern again. I brought up, let me go to daily real quick. You'll see daily, we're just back to trading around the 200-day moving average. Here's the 200, went right back to the 200. Everybody was convinced up here we were going up forever, stonks to the moon. and then we came all the way back to 200. We bounced. Now we're back at the 200. The only good thing is there's a slight upward slope here on this. When we look at the algos, they're looking at a potential turn, but nothing that is suggesting that we're going to get a big rally at this time. Maybe a retest of the recent highs, but more likely this goes to my hypothesis, which is a absolutely broad range consolidation range from that standpoint. I don't see anything different. All right, so let's get into the treasuries. You know, before I start this, let me go. Let's do something else here. This is one of my favorite charts, and I saw some people. We have a private Discord. I saw some folks talking about that there. Yeah, so just real quick before I get into, somebody's asking why did I stop? I still use TradeStation. Okay. Matter of fact, here's my trading screen. That's where I trade. Okay, so that's still part of my life. The reason why I did that is because we're able to distribute our technology and our indicators on TradingView. TradingView is a reasonable format. It's not the technology in TradeStation way more powerful. The Pine script and TradingView is, I wouldn't call it a joke. You can do a lot of stuff, but there's a lot of limitations on what you can do. In fact, I have a guy who's worked with me for 35 years. I don't see him on the line. A lot of times he'll come up. He complains. I'm like, hey, dude, can you write this Pine script for me? And he's just like, every time he comes back, he goes, man, this stuff is so old school type thing. So anyway, there's your answer. So what I want to look at here is I want to go to this chart. Some of you have seen this. Let me just bring this up. This is a pretty amazing chart. There is a video I did. I think it was called Interest Rates Projected to Go to Zero. And this chart here is very interesting from the standpoint of what I've recognized. Now, I went back in that video, and I think I went back to 2000. And every time the Fed has held rates artificially, like if you look off to the left here, let me just get off screen so you can see it fully. If you look off to the left where this flat area is, this is where they held interest rates at basically zero. The longer they held them there, look at this big ramp up. And my argument back in these days, if you were hanging around me, is that rates should have been somewhere around 2.5% to 3% back in there. So when they finally turned the spigot on, they got it all the way up here, and now we've went flat for a number of months. And every time we've had one of these flats, we see an inverse happen in the interest rate. So the longer they hold them artificially in a range, which is what we've seen up here, then you start to see this move down. So what's being forecasted here is that this level here is 415. This is the Fed funds. Let me just come up and talk a bit about this number, because it's important to yeah, so it's important. I lost one of my lights on my studio. I'm not sure why. Anyway, it's important to understand that when the Fed, I've been arguing that the Fed funds rate should be at 0.25. And this is another thing. You see a lot of stuff, just amateur stuff, to be honest with you. People going, the yield curve's no longer, because the 2-year is lower than the 10, the yield curve's no longer inverted. Yes, it is. If you look at the Fed funds, which is artificially being held where it's at. But if you look even at all of the T-bill rates, everything from the 13-week to 1 year, you're going to see them well elevated above in the 480 plus level. And until those are market rates, by the way, but they're heavily influenced by that front end freeze by the Fed, where we've seen at that 5.25, 5.5 rate, which I think the effective rate is around 5.33 every day. So what we're seeing, until we see that come down and we start to see an inversion here, I think I've shown you this website in the past. Let me come up full screen here for a minute while I get this up. But I'll show you one more thing. We're going to go into, this is probably the most important thing to go through right now. So let's go ahead. Bear with me 1 second here. All right, let me put this back up for you. So there's a website called, I think it's, U.S. Treasury Yield Curve. It's actually pretty good. They have a Patreon that you can get. But one of the things that you can do, so they're asking for money, but they'll let you use it. It's an interesting site. One of the things that I really like this for is I can come up here and pin a point in time where I can go back and set it to, I'm going to set it to January 1st. And the red line now is what the yield curve looked like at the beginning of the year. This is how the slope. So you can see overall everything has come down and it's starting. But my expectation, or what I'm expecting to see, and I've drawn this in on a couple charts in the Substack. So what I'm looking for here is ultimately for Fed funds to get down here where I'm right above where I'm setting here and see a slope something like this, where we have the front end of the curve around 3.25, could be as low as 275, and then the back end of the curve isn't going to come down as much as people would think. I think we probably stabilize somewhere around this, could be 3.5, 360, but then we start to come back into around 4%. And this would be like a super healthy structure for interest rates from the standpoint, from a banker standpoint, and from everything that you have here. This would be the perfect setup. Okay, so let me take this off and let's go back to this other chart. So we come back to this chart, and the expectations are going to be for the market to start to see it start to decline. And like I said, this is being forecasted. The first forecast month is right here is September, which is forecasted to be at 420, which is a quarter point. So we'll see how this works as we go forward and see how well this tool has forecasted. But I can tell you, if you go watch that video I referenced a minute ago, it forecasted every move so accurately, literally sometimes as much as 1 to a year and a half in advance of where rates were going. And it seems, how did it do it? It's just really, what's interesting about interest rates, they're very methodical, and there's there's the largest market that exists, commodity market in the world, is currency. The second one is debt, okay? And then it's everything else downhill from there. But these are the biggest markets, that trillions and trillions of dollars of debt out there that is being, so when these things start to move, they just kind of keep tipping over. You can't, there's so much weight on them, you can't stop them. And when they start to go, the mentality and the market's sentiment is heavily driven. But so those are what I see. The Fed wants to ultimately go to the next step. They probably started here. I don't think they're going to do, I believe the next Fed meeting is right after the election. They may start on this meeting and start to move from there, but they've got a long ways to go. Like right now, to get to this level, we're looking at potentially maybe at least 2 quarters, and this is going to go from this is 100 basis points. So they're probably going to do something very methodical. They're not going to just go ahead and drop rates 50 bips at a time. There's no reason for them to do that. And especially if my inflation talk that I just talked to you about becomes reality, which is that we are going to get a little echo bounce in CPI, PPI. I get brought up PPI. It has same kind of configuration on from that standpoint. So that's pretty much how I see things. So let's do one last thing, and let's go to let's take a look at the actual Treasury chart here, and that will. So here's what we're seeing right now. This is a daily, so red dots are still looking a couple sessions down yet, and that should be that should be the continuation of what's going on from that standpoint. We should see that. Then it's got a little bounce back to three 370, but you can see the angle of attack. Let's bring up the algos. You can see the algos are starting to forecast a turn as we come in toward the end of the week and coming into next week, where rates are going to start to uptick again. Whether this is just profit taking on this rally that we've seen in the bonds, they're just most likely just some cash flow beforehand, and then it kind of builds here for rates to go higher as we come into the end of September. So it's going to be fairly interesting to see how everything plays out from there. So let's see where we are. We're at 47. Got about 12 more minutes to go. So let's take a look at gold, because somebody made a comment about gold that gold is if rates do decline, then that's probably going to be a positive for gold. Maybe I don't think this is going to have the net effect on these markets that some people are thinking. I think it's so priced in that it may not even matter. But markets, we've got. I talk about this a lot. I believe we have two things. We have a new class of investors. I remember my first big job after being in production, and I was still in production and being part of a major research department, was when I was 36 years old. So I had to slap myself and remind me that once upon a time I was the 36, 40-year-old guy talking about the market. So we became, there was a change of guard, if you will, from the old dudes to us. And now we're getting that change of guard again from that standpoint. Okay, so let's go ahead and take a quick look at gold. And I'm going to cover, in a few hours, I'll start writing the Substack. But let's take a look at gold. There's an interesting thing. This is the daily gold. There's a bit of distribution going on here. So the overall pattern that's being forecasted out is stable. You have a rising 40. You have these other moving averages flat. So we're probably going to stay in this range. If we're going to figure out anything, we're going to have to go to the weekly chart. Let me just adjust this a bit. So what's good about the weekly, we still have a reasonable angle of attack on PPM1. This is that top indicator with the white. That is at 0.59. That suggests there's literally a 30% probability for the market to decline below that value, which is the 10-week moving average, 2486. It's rising. Let's see what it's rising by. rising by about 15 bucks per week. So that number's rising, and it looks like from the August standpoint, we come into the end of September, there could be some downward pressure there, and we'll see what the scenario is around that. But if you look at all the algos here, they are projecting that the price is likely going to be declining as we come in to 2025, or the momentum's going to be bleeding off, which tells us we should go toward the 21-week moving average, 24.15, possibly getting down into this range, maybe 23.80, maybe back in below 24 handle. And we've satisfied all of the Fibonacci targets. So where I put my cursor just now, the Fibonacci targets at the time, let me turn this up. This was back on March of this year, on March 24. We had three projections. We had 23.25, 24.50, and 25.28. We initially hit this 24.50 right here, and we rejected off of that. And then we got one more new, we kind of went consolidation, and then we traded up to that fib target finally at 25.26 was that number. We got up to a value here of, we get this right value here. We got up to 25.70. So we satisfied all the fib targets. So that pattern objective that I was talking way back in March got hit. We rejected, consolidated, have one more new high. Now you can see here on the weekly charts, all of the momentum is flattening out and being forecasted to continue to decline, which means we're going to go through stair-stepping through the moving averages. So we're going to come through at some stage the 10-period moving average, which is probably not until maybe the end of September, early October, and then from there we'll probably stair-step back to the 21 period moving average, or 21-week moving average, which is 24.15, and then the 40 would be the ultimate target. It's 22.70 right now, but it's rising along the slope. But everything is projecting that we're going to see momentum bleed off, market sideways to down over the next couple months. So, yeah, so let's see what we got here. We got 8 minutes. Let's go ahead. Somebody asked about silver and oil. Let's do quick silver. Silver's not a good looking chart last time I looked at it. I know all the JP Morgan stories, all the stuff here. This is sort of interesting. Same kind of scenario here. This is a weekly. You can see the red dots are forecasting, kind of trading along these moving averages, getting into early October is where we'll be testing some support. These numbers could all change by then, but we do have drifting sideways. I would say that the moving averages in here are probably going to be the ranges, which is, let me get the numbers here for you. They're going to be 29.26 on the upside, the 40, 26.97, call it 27 bucks. We're probably going to be locked in that range, but the stable until the early October, and then there's some momentum loss, and you can see the projections here. So not a lot going there. So let's go ahead to crude oil. So this is always an interesting scenario. I'll show you a couple of things. I haven't covered crude for a while, actually, and that's used to be my daily staple. So coming back over here on the July 24th, and this is why I'm just telling you folks, you get the indicators, you'd know this stuff, whether I cover or not. So there were three Fibonacci targets, 69, 33, 63, 53, 59, 94. Now we're coming towards Fib target 2. We've got a low of 65.27, target 63.50. But you can see what the algos are suggesting. This is actually really interesting because this is suggesting, I talk about these V bottoms all the time. This is almost a perfect V, not right here. This is suggesting this is the final week and we should see prices start to recover toward the 10 period moving average. So this Fibonacci target, middle fib target at 63.53 is probably the floor. And then we're going to come up, and I'm just estimating if these dots are right. As we go forward, we're looking at, 72 bucks. This is a lower range than we have been, so we've broken out of this bottom in the range. Let's since I haven't covered it for a while, let's go ahead and look at the monthly. Okay, so monthly this is somewhat interesting. Monthly is at the extreme, so this large this gold line that's on the outside is the market grid. That extreme 64.03, we printed, like I said, 65.27 so far. This is even showing some stability, and what's most interesting is the very bottom indicator on this chart way down here is actually starting to turn up, which is the 200 period moving average, or 200. This is a monthly 200 month moving average is coming right through this action right now. It is at 73.05, and we still have some downward pressure. So there are Fibonacci targets here that I will discuss on a monthly is $60, 35. That's fib target one monthly, 49.91 and 43.47. So what we could try to derive from that is that it's possible that we're going to see somewhat of maybe there's an economic slowdown, maybe there's something coming here, maybe we've already had the slowdown, but they didn't tell us because they falsified the employment numbers at some stage. That was it. I just noticed somebody said they were born in 1979. That's pretty funny. Yeah, I know. Long time ago. So anyway, let's go ahead and I'll cover Bitcoin just real quick. I think there's some interesting things going on there. I want to go over to the weekly on Bitcoin. Bitcoin's starting to forecast back into these moving averages, but we still have some challenges ahead. And it's interesting because if we go back to the halving event way back here in March, we've just been consolidating. And I've talked about this as well, as while the ETFs have created a lot of liquidity and a lot of activity, what it's done is it opened up like I was telling a buddy of mine the other day, is they brought the bad guys into the market. So they brought in the ETF guys and the arbitrageurs in a big way. So now they have a way to play with this market, and the distribution of assets is not allowing this thing to get traction to go up right now. You've been much better off just leaving everybody was so, oh, the ETFs, it's, to the moon, we're going to go to 100,000, we're going to 200. Maybe we do, but what's happened at the moment is that there's massive distribution going on. And the scary part of this distribution is the minimum target is the 200, which is way down here at 37,700. Now, I'm not saying it's going to happen. It looks like we want to trade back up into the resistance, but we're still locked. I'm going to go 55,000, 62, 64,000 on this market. So I'll come back up on screen. Sorry for the lighting. I keep having issues with the lights over here. Shout out to the man behind the curtain. Yeah, I think, I don't know if you got that comment from me, but back in the day when floor trading days, I had a buddy that used to always scream out, "Do not pay attention to the man behind the curtain." And that was when the arbitrageurs came in, they'd distort the market just for a little bit. Well, now we have a man behind the curtain all the time, which is a lot of these algos that are trading in the markets. We get that all the time. So let me just look at some comments here. Dragon Head Monthly. Yeah, you could argue that. This chart here, though, on the weekly is this just so this is a distribution pattern, and there's a lot of issues here from the standpoint of what I'm telling you. Bringing these ETF guys in was not that good of an idea if you're a pure Bitcoin, because now you're bringing in, like I said, the market makers and all the arbitrageurs and people that have figured out that, trust me, there's a lot of volume around these instruments. So there's a lot of opportunity for making markets and doing things in there. And that's what it looks like when we're doing that. I'll just pop that on the screen for just a minute here. Yeah, so that's what it looks like. That activity there is exactly what it looks like when you're getting distribution and you got a lot of players in there, and that's it. So, yeah, so somebody said happy anniversary. Thank you. It's hard to believe. I realized that, oh my gosh, it's been 45 years now. I had, I have to tell you folks, and I'll come back on screen. We'll call it quits here. We're right at 1 hour. I'd like to go there. Sorry about losing the lighting, but that's we'll deal with the technical. I'll figure this out by the time next time we come up. Anyway, like I said, my goal is to be up tomorrow to do another live tomorrow and Thursday. That's my hope. I'll let you know on Twitter. So if you follow me on Twitter at Portfolio Expert, there's no E, just an X, Portfolio Expert. And you can follow me there on Twitter. Most of the activity, I don't have a ton of activity on that platform, but I do inform things going on. I do post the Substack up there when it's available. And by the way, there's 7-day free trial. When I get done, if you've been on the fence, I'm going to lower the price back to actually 1 year full price would be $8, and if you go month to month, I think it's whatever. You get it for $80, so it's under $8. I think it's $6.65, and if you get if you pay month to month, it's like $88. So I'm going to do that anniversary. We'll call it anniversary special, and but make sure you get that kindlereport.substack.com. The indicators at kindlereport.com/indicators. And, I would tell you it's going to be really exciting. Oh, there's something I wanted to show you, and I'm mad at myself that I'm waiting for this. I got distracted when I was going, but I do want to show you one last thing. I'm gonna go back, and I want to show you on the portfolio manager. So this is WaveTech, right? I'm going to bring up. I did a hack on IWM. So I did a short-term hack. I want to show you what's happened. I call it the dynamic dozen. So there's 12 stocks. I'll bring those up so you can see this. Hate to do this right at the end, but I've just realized I didn't do this. This is the list of stocks. So you can pause the screen if you want them. These are the stocks that are trading in here. If we go over to open positions right now, we've seen a big move. We did own just virtually all the stocks. These are the current open positions. And if we come over to the trade log, you can see just we've sold out all of these stocks here. So what's happened, I'm going to the summary page here. We went from basically 100% invested. We were up about 43%. So this little carnage that we had, we gave up about 5%. But you can see actually it was 6.6% in September. It's pretty ugly, that little hit. But what we've done is we retreated. Now we only have 45% of the cash invested, 54 invested, 45 is in cash. So we have a lot of cushion here, and the equity curve is going to freeze out here. So when we look at this equity curve, I'm going to close this out. It's not coming up right. But we look at this equity curve here, it's just going to go basically flat and consolidate. But this portfolio, everybody tells us that it's been all of the FANG stocks are driving it. Look at the returns on this: 21, 24, 26, 16.24, and 22, which was a terrible year, by the way. 23, 50.41 this year, 38.59, and right now we're protecting that capital from that standpoint. But I wanted to show you that because there's a difference when you're trading these indexes and ETFs. Long time ago, I used to say ETFs was an effort by Wall Street to make investing easy, and it's never easy. Okay, and all they did was dilute your possibilities of making real money. The only way to make real money in the markets is trading individual symbols, concentration of assets with good strategy behind it, which is a ability to participate when the market's going up, protect when things get risky. That's the only way to really accelerate your money and make some serious money in the market. So we're going to be really getting interactive with you folks. I think it's important for you to understand. I haven't talked about WaveTech for a while. It's just kind of there. We've got a fair amount of retail folks that use it now, and our institutional, for the most part, the institutional folks are on our Portfolio Expert, which is available to you as well. But I meant to show you that when I was going through the Russell, because it's not just the FANGs that are working. And I've been arguing throughout the year that the reality is that there are a lot of stocks if you're willing to look outside of these indexes. And all of the indexes are heavily weighted towards stocks. And one day I'm going to do a video on how almost every ETF is structured the same, and how I do something called ETF hacking, where I go in and dissect the ETFs and then make them better from the standpoint of two phases. One being able to cherry pick out of the entire universe. A lot of times what we find is the stocks that are underweighted are the real jewels, but ETFs operate, I'll just say this and we'll close it out, but ETFs operate on, they've got to have that top end highly liquid stock so they can put a lot of money in there. You can't put a lot of money in some of these secondary stocks, but the real moves are in the secondary stock. So someday I would teach you folks how to do that. I've been doing that for this product here, has been around since 1998. So not 45 years, but quite a few years. It's getting to be on 26, 27 years. So I will show that to you. So make sure before you leave, hit the like button, subscribe, all that stuff. Like I said, look for me to come up in the next couple of days. I really appreciate it. Anyway, have a great day. We'll talk to you all very soon.